All right, welcome back everyone for another weekend review. Just a heads up, we're not really going to do a flirt, date, or dump segment. We're going to do a lot of earnings are coming up in the next few weeks. We're going to do a specific video for a look ahead on some companies and break down some of the earnings and what to expect. So we'll do a brief rundown, but no flirt, date, dump segment this week. That being said, we are going to recap and look forward to next week. Welcome back. So obviously this week the headlines were dominated by the CPI on Wednesday. It goes without saying that right now where we're sitting, I would say more of, in my opinion, this kind of actually goes beyond the actual equity markets, investment markets themselves. Inflation has often been coined the cruelest tax of them all, and a lot of times because that it's a disproportionate tax. So if you think about every dollar that goes into the system isn't distributed evenly. All right. So, for example, every new dollar introduced into the system, a company like Apple or Amazon or a company that has large footprint throughout the United States is going to receive a much larger percentage of that additional dollar than someone who is just delivering pizzas or working as a bartender or maybe working at a Disney park or something like that, right? So your gains are going to be disproportionately skewed to your larger companies, your larger individuals of net worth, et cetera, et cetera. So that, along with the fact that a percent of the income that is dedicated to energy, dedicated to housing, a lot of these essentials is a lot higher for your lower wage earners than is for individuals making $5-10 million a year. The reality is oil could go to $20 a gallon. It wouldn't seriously affect them at all, really. Because of just the percent is negligible of what they have to spend on some of these. So going beyond the market, that's kind of my take on the importance of this issue. Is it doesn't just affect the equity market. Obviously, it does affect the equity market itself, but in my opinion, I think it's actually something that goes beyond the equity market in of itself. The print on Wednesday read 9.1%. Now, however, that being said, I have read some articles. The way we actually measure this has changed. So pre-1982, what they used to use was basically the housing cost more directly, and they would include kind of maintenance cost within the actual price of itself. And what they did, and it's been kind of controversial, and unlike some people, I do see the pro and cons to what they did. Post-1982, what they use is now actually your kind of like your rental. So pre-1982, it was called OER, so your owner equivalent rental. And what that's done is kind of changed the way that these inflation readings read. So if you basically dated this information and used the pre-1982 method of calculating inflation, you would have had readings a little over 12% from what I've read. Now, the instant reaction to a lot of people online is, oh, it's because the government's trying to skew the numbers because of inflation and stuff like that. And well, I'm not necessarily going to argue against that case. I think it's a little bit more complicated than that. First of all, it is a lot more simpler to basically calculate what a living cost is based off rents. It's more direct. You don't have to gather as much information when it comes to maintenance, upkeep, and stuff like that, because rental companies obviously calculate that into their rental requirements for the month. I mean, they're obviously in the game to make money, so all of that's going to be included. Now, where things get a little bit more complicated is I do also, if you look over, like, for example, a 20-year stretch, it does tend to underinflate the number. So if you look, and I'll put a chart up on the screen, if you look actually over a 20-year stretch, there's two things that this has done by changing the way we calculate numbers. One is it's removed a little bit of the volatility. So your higher readings are not going to be as high as what they would have been pre-82, and your lower readings would not have been as low. However, that being said, it does tend to skew it to the lower side, because if you look at an overarching stretch, your compounding effect is the fact that the new calculation tends to err on the underside than on the over, which again, I do believe is convenient for the government because of the Social Security inflation adjustments that they have to do every year. It saves them money. So all that being said, we're in a situation that any way you want to slice it, we're basically in a hyperinflation situation. Double-digit inflation year over year is hyperinflation. There's no way to slice it. And while I don't believe the Fed will raise 100 points, I don't understand why they shouldn't. Like I said, from a societal standpoint, this is one of the bigger issues that, as a population, we could potentially challenge or face, because it's disproportionate. It affects the people that are lower income earners more than it does, obviously, the wealthy. And you've already seen reactions across the world. My last week pod, I talked just briefly about how the English central bank was actually going to speak. You already seen Canada. Canada did a 100 basis point hike to basically cut out their inflation. So basically, with Canada setting the stage of doing 100, I don't see the issue with us potentially doing 100. However, like I said earlier, and a few episodes ago, I didn't believe the Fed in 2018. I didn't believe them in 2020 that they'd do the right thing. So why do I believe that they would actually have the stones to go through with a 100-point hike, even though we've already seen other banks around the world start to do that, mainly our neighbors to the north in Canada. So again, they didn't have the fortitude to do it in 2018. They didn't in 2020. So I think we're just going to be in a period, and I think the market is beginning to price in a period of basically stagflation, where we have high inflation readings every month and no growth. And I think that's an environment that unfortunately doesn't benefit everyone evenly or proportionately. But that's kind of where the market's been setting up the last week or two. We've kind of come off the lows a little bit, and I think based off the rotation that I started to see, and I mentioned this a couple weeks ago, how growth has started to outperform. The only way growth starts to outperform is if they believe we're not going into a recession, but instead we're going into a stagflationary environment. And to kind of further reinforce this point, so housing, which a lot of your Wall Street and kind of other investors or whatever, they use that as a tax haven to artificially deflate their line item for income for the year. Housing in the last 5 years has been up 60%, but wages are only up 15% in the last five years. And if you go back to a multi-year average, traditionally a home is around 3.5 times your income. So your average price of your home is 3.5 times your median income. Right now we're sitting at 6 times the median income, which has made housing more unaffordable than any point in time basically in our generation. So you saw that on Wednesday. That was the main show, if you will. Even though there wasn't as much volatility on Wednesday as I expected, I think with the leak on Tuesday, you already started to see the markets kind of react. And then on Wednesday, it's kind of like, well, we've seen the highest reading that we were probably going to get. And we don't believe the Fed is actually going to press the issue anymore. If we start to see inflation go from, a reading of 9.1, which again, going back to the discussion we had earlier, is actually above 12% adjusted the pre-1982 readings. So if that's going to be our highest print that we're going to see on inflation, we don't believe the Fed's going to carry through much farther on interest rate hikes to really fight the inflation. They're probably just going to try to drag this out as long as possible, and hopefully supply side kind of eases some of the demand issues with more housing builds and kind of the same thing I discussed a couple weeks ago, more commodity exploration and development, whether it be oil, copper, or any of the hard commodities, if you will. We also saw retail sales that came in higher than expected month over month. That was on Friday, and that kind of just helped us really rally into the end of the week. So we had a week that was basically flat. I think it was 0.1% to the downside of the S&P. So for all intents and purposes, we were really flat on the 5-day trading window. But you did see some big kind of dips and rallies within the week of itself. And then another interesting note, next week we do actually have GDP print coming out in a couple weeks for the U.S. Last week we had the GDP print for England coming out, and it came in actually higher than expected. And I think we're going to see a trend here as well. I think that's going to be a little bit of foreshadowing. The economy in Britain is similar of structure to the economy in the U.S. as far as it's very service heavy, and there's a lot of kind of technology, and the actual makeup of the GDP the weights of where the different development's coming from is more similar to the U.S. than, say, for example, a Latin American country or something like that. So their reading coming out higher than expected, I think, is a good sign for us going into our reading coming here in a couple weeks. And that kind of is also going to be a foreshadowing into what I have looking for the look ahead for next week. Tuesday, we have housing starts and building permits plus existing home sales. So we're going to have a lot of data on the health and the state of the real estate market. And again, this is very important because one of the largest components for inflation is actually housing data itself. And again, it's not housing prices as much as it's housing rental. So the fact that they're using rentals has been a little bit of a buffer. That being said, the information is coming out Tuesday with housing starts, building permits, and your existing home sales. If you see a little bit of softening, I think the market's going to rally because going back to what I mentioned earlier, as far as the disproportionate gain in the housing market over the last 5 years has made housing unaffordable, and that's kind of one of the targets the Fed is looking at to help bring inflation down. We also have crude oil inventories on Wednesday. These are important again for the same exact reason. We've seen a softening in crude over the last couple months. A lot of crude equities are down 25% or so from their highs. And we are actually looking at a situation where a lot of individuals were calling for $80, $85 barrel in oil by the end of the year. I actually was kind of one of those individuals who thought we'd probably see 80 heading in towards the end of the year. We're having estimates as low as 65 as well. I don't quite think we'll see that number because that is roughly basically what their input costs are for a barrel of oil is about 65. So that once you start hitting the 80 level, you don't really see any more development or any more supply added onto the market. So at that point, I think there will be kind of a balance that has begun to struck between supply and demand, and I don't really see us going much below 80. However, that being said, that's still lower than we're sitting at today. So Wednesday crude oil inventories are important. We're still having SPR releases, so that again should help build inventories and also kind of help put downward pressure on oil prices heading into the week. So like I said, we do not have the flirt date or dump segment, but there are quite a few earnings. So I'll go ahead and go through a list of some of the major ones that are coming out and what I'm looking for, and then keep your eyes peeled because I will be dropping a separate podcast on specific earnings and basically a deep dive into a few different equities positions and kind of a lightning round as well as to what to expect from a few different names coming out this week and the following weeks. So Monday you have B of A and Goldman Sachs. Again, you saw this week a lot of the banks reported they weren't as bad as what was being priced in the stock. The reserves weren't as depleted, or I'm sorry, they weren't building reserves at the rate that people were expecting them to, which again is a good sign because that means that they see things potentially softening, but they don't see us heading into what would be kind of like a 2008 style deep recession. And at the end of the day, their commentary can be whatever it is, but their book talks of kind of what would be maybe a light recession to a stagflationary environment as far as their loan capitalization goes. You also have Goldman Sachs on Monday. So again, you kind of have your traditional money center bank and Bank of America. Goldman Sachs is going to be where you're trading banks. I discussed this a couple weeks ago in my flirt date dump segment. These guys, I think, are going to do better than expected. I think their costs of labor are going to be down compared to what the street's expecting. And I think they always hit the ball of the park when it comes to execution on their equity management side of the business. Tuesday, we have J&J. It's one of, I believe the number is 18 stocks that were within 5% of the all-time high midweek. So obviously, we've had a very rough market. This has been one of the few stocks that is actually within earshot of their all-time high. I think this is important because of two things. You have a little bit of resistance around the 77 level or so. And it's a key figure to watch because this is what you would consider more of a defensive play. People enter J&J because they think it's a great company, but in downtime, and it's going to outperform because maybe you're sideways to up slightly, whereas your growth names are going to be your source of funds for companies like J&J. So I think on Tuesday, you're going to see, does it kind of break through that resistance or does it kind of fall off? My bet is that you're going to see it start to become a source of funds as you start to see investors move more and more towards growth as we head into what will probably be a stagflationary environment, because the Fed probably will ease a little bit And instead of us going into recession and killing inflation, we'll probably end up in more of a stagflationary environment. So I think J&J becomes one of those companies that becomes a source of funds for your more growthier, loftier investments. We also have Netflix on Tuesday. So that's one everyone's obviously watching. For me, there's a couple big things that to look out for. One is, what are they stating as far as their plans are for a paid subscription model versus maybe an advertising model. What their thoughts are on that. And then obviously, how are they going to address basically password sharing? Everyone knows it exists. It's been around forever. I'm sure, you and your family or something like that at one point in time has used a Netflix account that you weren't a direct sub for. How they address that? What are they doing as far as content spend as well? Are they looking at potentially pulling the reins in? Because I think there's going to be a period of consolidation. Right now you have a lot of people that are going to DTC or direct to consumer with streaming. I think that field is going to kind of consolidate, whether it be through M&A activity or whether it be kind of the weaker individuals, the smaller players slowly dying off. I don't think Netflix will be one of those players that dies off. So it's very interesting to see, are they going to pull back on spending for content? And will that kind of have an effect on some of the other players in the market? We also have Halliburton on Tuesday. So the reason they're important is they're one of the first of the major oil service to report. It's going to be very key as to what they have to say as far as the major oil producers, what they're looking for as far as CapEx spend going into the end of the year. Wednesday, we have United. They're going to be the second of the major airlines to report. We already had Delta. We have Kinder Morgan. So again, we have another major player in the oil and gas field. And then one I'm really keeping an eye on is CSX. So they're important because the transports, if you're going to see a slowdown, transports typically are one of the ones that are going to slow down first. If you have less goods that are being bought, sold, you have less goods that are obviously being moved around. And with everything that's been going on with COVID, I think you had a very tense supply chain, very tight supply chain prior to COVID that was very close to a breaking point with any sort of stressor. And obviously that completely capitulated the supply chain. Everyone knows about that. So for me, looking at CSX is kind of what their guide is going for the end of the year. Do they see the fact that there's an inventory glut and people are tending to order and ship and move less product? Or are they kind of seeing basically a relief of the tightness in the market so their margins are getting compressed? However, they still see a high volume, a high quantity of goods being moved. Thursday, we move into DR Horton, ticker symbol DHI. Again, it's one of those that's going to be facing resistance at roughly the 76 level. These guys are going to be very interesting because you also have all of the housing data that's going to be coming out Tuesday. So between the housing data that's coming out Tuesday for builds, permits, and existing home sale, and what DR Horton says on Thursday, I think it's going to be very interesting. It's going to be a tone setter for the housing market, and consequently, also I think the market in general. Because what they're looking for right now is for these guys to come out and say there's a weakening in demand, and there's going to be a drop, a substantial drop, or basically a flattening of housing prices. I don't know what they're seeing on the ground level, so that's kind of what I'm looking for on Thursday. You also have American Airlines, so it's going to be the last of your major airlines reporting. And then you have Nucor. These guys are one of the major players in the steel and commodity space. The big question there is, do they foresee commodities in a temporary reprieve, or is it in a permanent bear downtrend? I personally have the feeling that we're kind of in a temporary reprieve, and the second the Fed takes their foot off the brake pedal with interest rate hikes, I think you're going to see commodities again start to rally. That might be 3 months from now. That might be 6 months from now. I'm not sure. But it's going to be interesting what Nucor has to say about orders, because the companies that use these products have to order months in advance. So what does their bookings look like? Then Friday, to wrap it up, we have Twitter, which, again, that's the whole part of the whole Musk saga that's going on. Does he want to buy Twitter? Was it covered to sell Tesla, et cetera, et cetera? And then we also have Cleveland Cliffs reporting on Friday. Again, these guys are like Nucor. They operate in the commodity space. Schlumberger to round out the week, and then Next Era Energy. And then one that I'm really going to be looking at is American Express. So these guys, much like the banks, they see on the front lines spending habits. They were kind of one of the first ones to tip us off to a shift in consumption from goods to services. A lot of people had anticipated that move, but they were actually one of the first people to be able to validate it with credit card spend and percent of credit card spend towards those different categories. So it's going to be interesting to see what American Express has to say coming on Friday to end the week. All right, guys. Hopefully it gives you guys a little bit of look ahead, valuable information. Have fun. Have a great week. Look forward to the video for our earnings deep dive.